There is a quiet shift happening in the global financial system right now, and unlike the dramatic headlines that dominate television and social media, this one is unfolding almost silently. Most people are focused on stock market highs, interest rate decisions, or the latest economic reports. Meanwhile, some of the world's largest financial institutions are making decisions that suggest they see something very different developing beneath the surface. History has a strange habit of repeating itself. It never follows the exact same script, but the patterns are often remarkably familiar. Every major monetary transition has been preceded by subtle signals that were ignored by the majority until they became impossible to overlook. By then, prices had already adjusted, opportunities had narrowed, and what seemed obvious in hindsight had been invisible in real time. Today, many of those same signals are beginning to appear again. This isn't about predicting the collapse of the global economy. It isn't about claiming the financial system is about to fail tomorrow. Markets are far more resilient than many people believe, and economies have an incredible ability to adapt. But adaptation often comes with consequences, and those consequences tend to reshape where wealth flows over long periods of time. The question isn't whether uncertainty exists. Uncertainty has always existed. The real question is where experienced investors, central banks, and long-term institutions choose to position themselves when that uncertainty begins to grow. The answer may surprise you. Before we continue, I'd like to know where you're watching from. Leave a comment below and tell me your country, and let me know whether you currently hold more of your savings in cash, gold, silver, or other investments. It's fascinating to see viewers from every corner of the world facing many of the same financial questions despite living in completely different economies. To understand why gold and silver have suddenly returned to serious conversations among economists and professional investors, we have to step back and look at the foundation of the modern financial system. Money only works because people believe it will continue to hold purchasing power tomorrow. That confidence is incredibly valuable. Without it, every transaction becomes more difficult, every investment becomes more uncertain, and every financial decision requires greater caution. For decades, the United States dollar has served as the backbone of global finance. It became the world's reserve currency because it offered stability, liquidity, and trust. Governments stored dollars. International companies conducted trade in dollars. Commodities from oil to copper were priced in dollars. Investors around the world viewed U.S. Treasury bonds as one of the safest assets available. This system created extraordinary advantages. But even the strongest systems experience pressure when the conditions supporting them begin to change. One of those pressures is debt. Debt itself is not necessarily dangerous. Every country borrows money. Businesses borrow. Families borrow. The problem begins when debt grows much faster than the income needed to support it. Imagine a family earning $50,000 a year while carrying a mortgage that fits comfortably within its budget. That debt may actually improve their quality of life. Now imagine the same family doubling or tripling its debt while its income barely changes. Eventually, the monthly payments consume a larger share of household income. The family's financial flexibility begins to disappear. Governments operate differently than households, but the underlying mathematics are surprisingly similar. As debt expands, interest payments also expand. Money that could have funded infrastructure, scientific research, education, health care, or national defense instead goes towards servicing existing obligations. This creates a difficult balancing act for policymakers. Raise interest rates too much, and borrowing becomes more expensive. Lower interest rates too quickly, and inflation can accelerate. Neither choice is painless. That is why central banks often find themselves navigating between competing risks rather than searching for perfect solutions. Investors sometimes imagine central bankers possess absolute control over financial markets. The reality is much more complicated. Economic policy is often about choosing the least damaging option among several imperfect alternatives. Every decision solves one problem while creating another. That balancing act has become increasingly difficult over the past several years. Inflation surged to levels many economists believed would be temporary. Supply chains fractured. Energy prices became volatile. Geopolitical tensions increased. Governments around the world expanded spending to stabilize their economies during extraordinary circumstances. None of these events occurred in isolation. Each one added another layer of complexity. As a result, investors began asking a different question. Instead of wondering which stock might outperform next year, many started asking how they could preserve purchasing power over the next decade. Those are very different questions. One focuses on maximizing returns. The other focuses on protecting wealth. Throughout history, periods of monetary uncertainty have often pushed investors toward assets that cannot be created with the press of a button. Gold has filled that role for thousands of years. Silver has often followed, but with one important difference. Gold is primarily viewed as a monetary asset. Silver lives in two different worlds at the same time. It has served as money throughout much of human history, yet it is also an essential industrial metal used in technologies that define the modern economy. That combination makes silver unusually interesting. When investors become nervous, precious metals often attract attention. When industrial production expands, silver demand can increase for completely different reasons. These two forces don't always move together, but when they do, they can create conditions unlike those found in most commodity markets. Think about the devices surrounding you right now. Your smartphone, your laptop, medical equipment, electric vehicles, solar panels, advanced electronics. Silver plays a critical role in many of these products because of its exceptional electrical conductivity. Engineers often choose silver not because it is fashionable, but because it performs better than many available alternatives. Replacing it isn't always simple. That means industrial demand depends not only on price, but also on technological necessity. At the same time, mine production doesn't instantly respond when demand increases. Exploration can take years. Environmental studies require time. Permits can face lengthy approval processes. Construction demands enormous capital. Even after production begins, unexpected operational challenges are common. In other words, supply often reacts slowly, while demand can change much faster. Whenever that imbalance develops, markets begin adjusting through price. This doesn't guarantee dramatic moves tomorrow. Markets rarely move according to anyone's preferred schedule. But it explains why experienced analysts pay close attention whenever structural demand begins rising faster than long-term supply. Now consider another development that has received surprisingly little attention outside financial circles. Central banks have been increasing their precious metal reserves at one of the strongest paces seen in decades. These institutions employ teams of economists, risk managers, and market specialists whose primary responsibility is preserving national financial stability. They are not momentum traders. They do not chase headlines. Their decisions often reflect years of strategic planning. When organizations with virtually unlimited research resources steadily accumulate an asset over multiple years, serious investors naturally ask, why? The answer isn't necessarily fear. It is preparation. Preparation for uncertainty. Preparation for diversification. Preparation for a world that may become more financially fragmented than the one many investors grew accustomed to over the past several decades. That doesn't mean the dollar is disappearing. Far from it. The dollar remains the dominant global reserve currency. But dominance doesn't prevent diversification. Professional investors rarely rely entirely on one asset. Countries increasingly think the same way. Diversification isn't a prediction, it's insurance, and insurance usually becomes more valuable when uncertainty quietly increases. As we reach the end of this discussion, it's worth stepping back and looking at the bigger picture. Throughout this video, we've explored government debt, inflation, interest rates, central bank behavior, industrial demand, mining supply, investor psychology, and the long history of precious metals preserving wealth during periods of monetary uncertainty. At first, these may have seemed like separate stories, but together they reveal a much larger trend that is quietly unfolding. No single event guarantees that gold or silver will rise tomorrow. No chart can predict the exact timing of the next major move, and no analyst, regardless of experience, can eliminate uncertainty from financial markets. But history teaches us something far more valuable than certainty. It teaches us to recognize recurring patterns. When governments accumulate historically large debt burdens, monetary policy becomes increasingly difficult. When inflation remains persistent, purchasing power slowly declines. When central banks diversify their reserves, they are responding to long-term strategic risks rather than short-term headlines. When industries require increasing amounts of a metal whose production cannot expand overnight, supply eventually begins competing with demand. And when ordinary investors finally recognize those changes, markets often move much faster than anyone expects. The fascinating part is that none of these developments require a conspiracy. There are no secret meetings or hidden agendas behind what we've discussed today. Everything is available through public economic data, company reports, and central bank reserve disclosures. The challenge isn't finding the information. The challenge is connecting the dots before everyone else does. History has shown time and again that financial markets rarely reward the majority for reacting late. By the time an opportunity feels obvious, much of the move has already happened. That doesn't mean investors should rush into emotional decisions. In fact, emotional investing has destroyed more wealth than almost any economic recession. Fear convinces people to sell valuable assets during temporary corrections, while greed convinces them to buy after prices have already surged. Both emotions feel logical in the moment, yet both have repeated the same costly mistakes across every generation of investors. The most successful long-term investors aren't necessarily those with the highest IQs or the most sophisticated market models. They are usually the people with the greatest emotional discipline. They build strategies before volatility arrives. They decide how much risk they can genuinely tolerate. They diversify instead of gambling. They understand why they own an asset before they ever purchase it. And perhaps most importantly, they avoid making permanent decisions based on temporary emotions. That principle applies whether you're investing in gold, silver, stocks, bonds, real estate, or any other asset class. Discipline consistently outperforms excitement, and patience consistently outperforms panic. If the coming years bring stronger economic growth, precious metals may still serve as valuable portfolio diversifiers. If inflation proves more persistent than expected, they may provide insurance against declining purchasing power. And if geopolitical tensions continue reshaping global trade and reserve management, demand could evolve in ways that many investors still underestimate today. The future doesn't have to follow one single path for gold and silver to remain relevant. Their role has always been larger than simple price speculation. For thousands of years, civilizations across every continent arrived at remarkably similar conclusions despite having no connection to one another. Empires rose, empires declined. Currencies were created, currencies disappeared. Political systems changed, technologies transformed the world. Yet through all of those changes, precious metals repeatedly retained value because they represented something that could not be created by policy decisions alone. Today's world is obviously different from ancient civilizations. Digital payments dominate commerce. Artificial intelligence is transforming industries. Financial markets operate at extraordinary speed, but human behavior has changed very little. People still seek security during uncertain times. Governments still face difficult fiscal choices. Investors still struggle with fear and greed, and markets still reward those who remain rational, while others become emotional. Perhaps that is the most important lesson of all. This isn't ultimately a story about gold. It isn't even a story about silver. It's a story about understanding the forces that quietly shape the value of money itself. The investors who preserve wealth across decades are rarely those chasing the latest prediction. They are the ones willing to study history, question popular narratives, remain patient through uncertainty, and make decisions based on evidence rather than emotion. Whether you ultimately decide to own physical precious metals, mining companies, diversified index funds, bonds, cash, or a balanced combination of them all, is a decision only you can make. Your financial goals are unique. Your responsibilities are unique. Your tolerance for risk is unique. No video on the internet should tell you exactly what to buy. Instead, my goal has always been much simpler: to help you understand the forces moving beneath the surface of the global economy so you can make informed decisions with confidence rather than reacting to fear or excitement. If today's discussion gave you a new perspective on the relationship between monetary policy, central bank strategy, inflation, and the long-term role of precious metals, then you've already gained something more valuable than a short-term market prediction. You've gained context, and in today's financial world, context is one of the rarest assets an investor can possess. Thank you for spending your time with me today. If you found this analysis valuable, consider subscribing, because every week we break down the biggest developments shaping the future of gold, silver, global markets, and the economy with a focus on evidence instead of hype. Leave a comment below and tell me one question you still have about gold, silver, inflation, or the financial system. I read as many comments as I can, and many of your questions inspire future videos. Until next time, stay informed, stay patient, and remember that protecting wealth has never been about reacting faster than everyone else. It's about understanding what everyone else hasn't noticed yet.